Hey guys, my name is Colin and this is Colin Talks Crypto. I want to bring you another video in my recent series of videos on the subject of the yield curve inversion, followed by the federal interest rate pivot, and then the final drop down to a stock market crash, a stock market bottom, and this pattern that I've observed over the past few major crashes in 2000 and 2008, even back in the 70s. This same pattern has taken place. And I want to dive into this in a little more nuanced of a view, because I realized I sort of made one oversight in that I jumped to the conclusion in my mind with my trades that the doom and gloom part was all I needed to focus on, that final portion of the puzzle where I'm saying that there's going to be one of the greatest stock market crashes that we have seen in at least 10 years, possibly since the Great Depression. I think that that's very possibly the outcome that we're looking at for the upcoming crash in a couple of years. And that thesis of mine has not changed. Keep in mind, this is my current best look at the situation. It's my best estimation of what I think is happening. I am by no means trying to push this idea on others or say that I am infallible or I cannot be wrong. But like you guys and like every investor out there, we're inputting data, we're reading data, we're trying to decipher what we see on the Twitter feeds, because you can see bullish and bearish everywhere you look. There's really conflicting opinions everywhere. And so you have to input all that data and then you have to come to your own conclusion. And so I'm just giving you my conclusion. I'm not trying to say that it is necessarily going to be right. I obviously think that it is going to be right because this is my current best take on the entire situation after having spent hundreds of hours digesting information. But I don't expect that everyone is going to agree with me, and that's okay, because if I'm right, yay, good for me. And if I'm wrong, I certainly don't want other people to be hurt by that. But I'm being bold enough to share my opinion on the internet, which not everyone is willing to do. And then I'll let you make your own decision. So I want to take a moment and just dive into some charts here. And like I started off this video saying, I noticed that I sort of had omitted a period of time where the markets are going to be active, and yet I'm not really factoring that in, which is the short term, basically the next 12 months. In my mind and my thesis, I had been just focused on this crash in about 2 to 3 years to this bear market bottom, which we'll get into later. But I realized, wait a minute, what's going to happen between now and then? We're not just going to necessarily instantly head down. And as the market has shown us recently, there has been quite a rally upward, in fact, on the shorter term. And so it's foolish to ignore the short term and only focus on the long term when there's a lot of useful information between now and then. I mean, you can be sitting on your hands for years doing nothing, missing some opportunities if you ignore the short term. And so I'm done ignoring the short term. And I've made sense of why we are pumping right now, and it does fit the past patterns. I just didn't dive in detail enough. So I'm going to do that with you right here. So let's take one step back and look at the three various markets. This is the S&P 500 on the top here. The second chart is the Dow Jones Industrial Index. And on the bottom here, we have the Nasdaq. I just chose these three indices for the sake of showing that they're all basically showing the same thing. I mean, you can see that they've all broken above this diagonal trend line, and as well as this local horizontal trend line, which was resistance and is now support. And that's the case for all three of these different indexes. You can see that the Dow Jones here is currently above 32,590, which was the local resistance, now turned support, as well as above the diagonal. And likewise for the Nasdaq index, it is also broken out of this diagonal, this long-standing diagonal. And so it would be silly to say that we're in a bear market in the moment, in the short term. And I think it's important to define timeframes. I notice this is a huge omission on really anywhere you discuss markets. Any person on Twitter, almost always omits their time frame, and it's so important. I think that this is like a glaring omission in the entire crypto space in terms of making predictions and talking about markets and direction and trading and analysis. It's omitting the time frame with which we are looking at things. And that was a huge revelation to me recently, because I've sort of had a hard time following these various traders, whether it's Big Cheds or Capo or Bob Lucas or Peter Brandt or any of these guys. They all have a different technique and they all have a different strategy, and they're all looking at different time frames, but they don't necessarily tell you that. And so one of them could say, oh, it's bullish, we're not looking back, but really they're looking at the next 7 days. And you might be thinking they're talking about the next bull run. This could be the next 12 months. Well, there's a big difference between the next 7 days and the next 12 months. And if they don't specify that, you can be caught making a bad trade because you're looking up to their decisions and their experience, which they are very experienced, but they're experienced with a certain time frame that they're not necessarily specifying. I think that's so important to understand. And now that I've grasped that, I'm going to be very careful from now on to clearly state the time frames that I'm talking about, because I could say, oh, I'm bearish, but that means nothing if I don't tell you the time frame. Am I bearish on a 1-day chart? Am I bearish on a month? On a 10-year chart? Like, what am I talking about? So I hope that other traders take note of this. They probably will never see this video, but please pass the word along to your favorite technical analyst and ask them what time frame they're looking at. Just as an example, I followed Big Cheds quite closely, and he's a master technician, technical analyst. But I realized that he is not long-term. He does not have long-term bags. He's not investing for the years to come, and he's not doing these massive swings, these massive 2 to 4 year cycle trades. He's just not doing that. He's looking at the next resistance and the next support, almost always. And that's how he can always kind of be right, because he's only looking at that next resistance, and he'll set his stop right above or below so that if he gets invalidated on his trade idea, then he's out. And so it minimizes his loss and he goes for those gains. But they're very short term usually. They're usually like a matter of days and maybe weeks at the most. And that was just, I had to really get my head around that because it was messing with my head, because I'm more of a long-term mindset. If you followed me for a long time, I have definitely a longer-term mindset on my trades. I like to do longer swing trades over many, many months or even years. So again, it's just important to understand, I think, that what we're talking about in terms of time frames. So here's these 3 charts. They've all broken up out of those diagonals. So I'm going to call my short term, I'm going to call that in the next 12 months. That's probably long-term for some people, but for the sake of this video, I have to put some definitions there on how I'm looking at it. So for me, short-term means the next 12 months, the next 1 to 12 months. So on a short term, we are looking bullish here. There's no doubt about it. We've broken above these diagonal resistance lines and they have become support. So in a short time frame, we are bullish. I'm going to define my medium time frame, of which I am very bearish, as starting from a year from now to 3 years from now. So that's a 2-year period starting in a year and going for 2 more years beyond that. So from 1 to 3 years away from now, I'm defining as medium term. And I am extremely bearish on that. I think that that is where we are going to see the stock market bottom and the crypto market bottom. And it's going to be devastating, and it's going to be on par with, if not greater than, 2008 or the Great Depression. I really think it's going to be of that magnitude. And we'll get into some of the details on that. But I think I've covered that in my last videos. So really this video, I'm going to focus on the next 12 months because I want to give you the more nuanced view. And that's the thing I came to realize is I had, like I said, jumped ahead to this super long-term crash view, which I still think is correct, but what about the next 12 months? So we're going to take a look at the next 12 months. And then lastly, I would define long time frame, a long term, as the next like 5 to 10 years. And I am bullish on the next 5 to 10 years for crypto and the stock market after that ultimate mega crash occurs in the next couple of years, then I think the money printer is going to get turned on. And we're going to see massive, massive gains for everything. Every risk on asset is going to surge upward massively. And we're going to see the biggest bull run we have seen since basically the end of the housing crisis until 2020 or 2022. We're going to see another huge run up like that. Could last for 10 years, for example, like a secular bull run. So I see that in the long term, and that's from 5 to 10 years from now. So now that we've established that in the short time period, in the next 1 to 12 months, we are in a bull run, or we're in a relief rally, or whatever you want to call it. It's bullish on a short time frame, right? Let's look at some other charts here. So on the top here, we again have the S&P 500, and then right below it, we have the dollar. Actually, I'm going to take that one out for now. We don't need that. So we have the S&P 500. We have Bitcoin right below it. We have the federal funds rate, which is the interest rate set by banks. And we have the yield curve inversion. And real briefly, because I'm not going to rehash this because I've already covered this in previous videos, the pattern that I observed is that after a yield curve inversion, which happened right now, a huge one, happened in the COVID crash or right before the COVID crash. And it happened back in 2008 and it happened back in 2000. I had to zoom out to the weekly candles here. So here's the yield curve that occurred right before the housing crisis in 2008, 2009. It was preceded by this yield curve inversion. And in the year 2000, we had the dot-com crash. And right before that was a massive yield curve inversion. So this pattern is yield curve inverts and the Fed funds rate flattens off and drops, and then we have a crash to the bottom. So I want to show you something interesting for the short term, for the next 12 months, which explains why we are seeing a relief rally and we're seeing a little mini bull run start here that could last for up to 12 months. So here's the little breakout that we just covered for the S&P 500. You know, right around here, Michael Burry, the star of the movie The Big Short, the guy who's famous for getting the housing market crisis short correct, tweeted sell, period. One word. And then the market shot upward the next day, and he deleted the tweet and deleted his entire account on Twitter with 1.3 million followers. So even the greats can get it wrong. Now, a lot of people think that he just got lucky and that he's been calling for a short for a long time now. My opinion is that he's probably eventually going to be right. Like, I think the massive stock market crash will prove him right in a couple years from now. I just think that he's a little early and he did not account for a relief rally in the meantime. And so that's what I'm trying to be really careful about, is looking at the short term as well as the medium term and long term. And for whatever reason, he did not account for, I mean, I can understand, I didn't account for it either until I started waking myself up and looking at the charts and realizing that there can definitely be a rally on the way down. And I think he just didn't account for that. So yeah, it sucks. He deleted his account. He was wrong on the short term, but he's probably still going to be right in a year or two. But to be honest, timing is very important in the markets. And so you can have the right idea, but have the wrong time, and effectively you're still wrong. I mean, you could still lose all your money. So you do need to be right on the timing as well. So I feel bad for the guy, but you know, he obviously felt bad enough himself about it that he deleted his entire account. Now let's take a look at the previous cycles. Let's compare where we're at in terms of the Fed fund rate being raised, the yield curve inverting, and where we're at on the chart. Now keep in mind, currently we have not yet finished raising interest rates. I suspect, I'm going to make a couple of assumptions for this video because we don't know exactly what the future is going to hold. I'm going to make the most logical assumptions, which I think that you'll agree that these seem likely. So the Fed funds rate probably will make 1, 2, 3 or so more small increases before flattening off. They may do another 25 basis points, another 25 basis points, and then go flat for a year, just maintaining that rate. I think that's probably the most likely outcome. Now, they might do 1 or 2 more or 1 or 2 less, I'm not sure, but something like that. They're going to flatten off in the next couple of months, but we're not quite there just yet. So I want to keep in mind that for when we compare this to the previous cycles. So now let's go back. I'm going to slide back the chart back to 2008. And this is going to give you an example of why I think that we are in a little mini bull run. So here, let's look at them both at the same time. Here's 2008, housing crisis, crash to the bottom. Here's dot-com crash to the bottom. And I've made some marks on here. So you can see this first thin yellow line here vertically, right here and right here, indicate when the Fed funds rate reached its top, reached its plateau, and they didn't increase or decrease it anymore. They just kept it constant from that point forward. So you can see that that's when that occurred there, and that's when that occurred right here. Now, what do we notice about that in terms of the stock market? Well, let's take it one cycle at a time. So back in 2000, when the Fed stopped increasing and started going sideways, we were roughly at the top. In fact, you could argue that the actual top was a few months prior to when the Fed stopped increasing the interest rates. But for all intents and purposes, I would say these three peaks right here, 1, 2, 3, these three peaks, these are basically the top of the cycle. If you were to sell at any of those peaks, you would have basically sold the top. So let's kind of take this range as the top of the cycle. That means that the top, as far as the 2000 cycle occurred, the top could be a few months prior to the Fed ceasing to increase interest rates. That's kind of where we're at right now. It's right around there. We're just before they start to level off. So that could be the top. Or it could be all the way halfway across when they're just holding and maintaining the interest rates, because here's the end of that peak before it collapsed. So you could wait all the way until the Fed pivots and begins to decrease the interest rates right here, indicated by this solid, more thick yellow vertical line, and you'd be fine. You would capture, in this case, 80% of the drop down for the remainder. This is the huge crash I see coming in our future. So it would not be an error to wait until the pivot to begin to take profits. But basically, my point is to show you that the top can occur anywhere between when the Fed is about done raising the interest rates all the way till about halfway through when they're holding it flat for about a year or maybe a year and a half, depending on which cycle we're looking at. Okay, so let's look at the next cycle. This is the 2008 housing crisis. So what happened? Well, the Fed very slowly and gradually for a long time, looks like for almost 2 years, raised interest rates all the way till they hit, I don't know what this is, 5, and they stopped around 5. That's probably what's going to happen this time, roughly. And where were we on the S&P 500? Well, when they stopped increasing the rates, we were actually in a little dip there. But look at this, a huge rally. I mean, this is massive. From the point where they stopped increasing the interest rates, now keep in mind, if we were to plot ourselves where we are in this chart, we're probably right around here. So, what could happen is we could have a massive rally. It could be huge. I mean, in this case, it actually made new highs from where it was before. I personally don't think we're going to see new highs, but I wouldn't rule anything out of the picture here. I mean, this is a long period of time to be going sideways with the interest rates. This is, what is this? July 2006 to July 2007. So that's 1 year of having gone sideways here. And during that entire year, basically, the stock market pumped. There was a little drop down here, continued to pump. I mean, that's an enormous rally. So this is my way of saying that for me to ignore this entire time period where potentially the market could be pumping and rallying before we get that final crash down would be totally foolish. And so I do want to look at the fact that this is possible. And the rally that we're in currently, like I showed you on that last chart, we've broken above that vertical resistance, which has now become support on all three of these indices. We are in a rally. How big of a rally is anyone's guess, but it could be a lengthy rally. It could be a short rally. And if we want to time it with the Fed funds rate, I'm trying to look at, well, when could this rally end? Well, if it's the 2008 housing crisis, the rally could go all the way to when we're flat for a year on the interest rates. So if I think that the Fed's going to continue raising interest rates for a couple more months, and then let's say they go sideways for 1 year, that puts us in April of 2024 when the actual drawdown, the last final massive crash occurs. That's 14 months away from today. That's when that could be. Or if we take the 2000 crash as our model, the peak actually occurred either right before they finished raising the rates or halfway through. So you can see there's a big difference here. And we only have 2 models, and this is not an example of every possibility that can happen. But I think it's a good place to start for a rough and approximate model. So basically, we want to be ready starting anywhere from today till 14 months from now, if it follows these past 2 cycles, when the crash could occur. And that means that the rally that we're experiencing could continue for anywhere from, in this case, it was halfway through this flat period. So that could be another 3 months, or it could be another 12 months. So I would say between 3 and 12 months seems likely for the current rally to continue. And that's what I'm looking at in the short term. I'm looking at, let's go back to where we are today, this Fed fund rate. Let me draw it here. Let me see if I can kind of simulate what I think is going to happen. We have this sideways period. So February till about February. Let's say it's something like this. They kind of ease off in a couple of months, and then we hit this flat period. So that's my guess, approximately, of what we're going to see. And keep in mind, the Fed has already basically told us that they don't plan on reducing rates anytime in the year 2023. So they're already kind of backing up the statement that this is true with their intention. So the current rally that we're experiencing, which has really just begun in the past month or so, could go for another 2 months, or it could go for another 12 months. And that's how big of a rally this could be. And so do I want to be sitting sidelined with 100% cash? Well, I don't have 100% cash. I have about 40% cash currently. Or do I want to take advantage of this? This rally could take us to here. Obviously it's going to go up and down, up and down. It's not going to be a straight shot like that. It might take us up to here. It might take Bitcoin, for example, up to 30,000 or 40,000. I think those are 2 likely places for Bitcoin to peak. Could it bring us back to the all-time high? Sure. Do I think that's likely? No. I'm not going to rule anything out. But I do think that there's room for a rally here that's not necessarily just going to give up. So if we only rally for another 2 months, yeah, maybe Bitcoin tops out. Here's Bitcoin right here. Maybe Bitcoin tops out around 30,000. If we rally for another 6 or 8 or 10 months, maybe Bitcoin does make it all the way to 40,000 or maybe higher. I don't think it'll break these peaks, but hey, we'll find out, huh? So I'm holding my Bitcoin. And if we do get up into this range between 40 to 60,000, definitely around the 40,000 range, I am going to begin selling some Bitcoin because, as I've stated in my medium-term expectation, that 2 to 3 years from now, I do expect to see a massive stock market crash. So we may have a relief rally, and I don't think that that's the start of a new bull run by any means. But again, we're looking at the shorter time period of up to 12 months from now. And so that's what I think is going to happen, guys. I think in the next 12 months, definitely going to be some ups and downs. It's not going to be a straight shot, but we could see it go as long as 12 months. It also could stop short in 2 or 3 or 4 months. But I think that that's what this relief rally is. It's definitely something to be paying attention to. And after it's over, though, that's when I would not want to be caught dead holding too much risk on asset, too much crypto, too much stock. That's when I want to be sitting in like 60 to 80% cash. I'll always hold some portion of Bitcoin as my HODL long-term position because I know that I can be wrong. But I want to weather the storm accurately. And if I see, with all the data points that I've absorbed in the past months of looking at videos and charts and data and looking at these patterns like the yield curve inversion followed by a Fed fund rate pivot downward followed by a stock market crash, I do believe that that pattern will continue in some form. So I don't want to be sitting on a bunch of assets when I could buy 3 to 4 to 5 to 10 times as many assets during the crash in a couple years. I just have to be patient. So guys, that's what I'm thinking. Let me know what you think is going to happen. Do you agree with my short-term 12 months assessment? And what about my medium-term 2 to 3 years away from now assessment? And then my long-term 5 to 10 years, massive bull run, crypto's not going away, going to the moon, new all-time highs, 6-figure Bitcoin, 5-figure Ethereum. That is what I see in the 5 to 10 years following the stock market crash. The Fed is pumping money, buying assets, trying to recover from that massive stock market crash that I'm seeing. And the way they're going to counter that is interest rates at zero and printing money like crazy and buying assets. And then to the moon we go, this direction, all the way to new all-time highs. Let me know what you guys think. Have a great day. I hope this was clear, and share it with your friends if you found this useful and if you think that they may find it useful as well. Have a great day, guys.